Welcome everyone. We are getting the last few people signed on here. Waiting for our attendee list to show up here. All right, see the first couple. This is kind of one of our new normal shows. We got advisors all over the country today. We got Paul Sr. and Ryan up in Minnesota. I'm the one who's down in Texas. Daniel's actually over in Alabama, visiting his girlfriend's family, and David is the one in Illinois. So only one of us is actually there with you guys. But we actually didn't get any questions, so apparently we've been doing a great job of answering them in past webinars. But we actually do have a couple things we want to talk about. If we just want to go ahead and get right into it, I think we have pretty much everyone here. I guess the first thing is, market's been going a little wild lately, I guess. Last week you sort of had that big decline at the end of the week, and about the time, by the time you have time to worry about a decline these days, it seems like the market comes back, and last couple of days have been pretty strong. It seems like the market got almost exactly to break even before it started its big pullback. And Dad, you sent us an article about break-evenitis. Should we talk about that a little bit?
Yeah, I mean, it's really common. I've seen it over and over in the last 36 years. People get kind of anchored to it. And I'm sorry for these are the only reading glasses I brought to Minnesota. Sometimes they look funny, and sometimes it looks like I'm putting up my nose to people, and I don't mean to. It's just because they're so small. Sometimes I have to look like I'm looking up. Yeah, just one second. Oh, that's okay. Yeah, our internet went out, so I'm in the hotel part of the resort, and I'm borrowing their Wi-Fi, so people could walk in and out. So anyway, getting back to break-evenitis, it's a real typical human psychology or trait, I think. It plays out frequently. In other words, we get invested, or we get to a certain spot where we're all happy. We get anchored to that spot. For some people, it's a certain number, like $500,000, or then if they get $1 million, they kind of get anchored to these certain numbers. Then all of a sudden they get a decline that shocks them a little bit more than maybe they allow themselves to be surprised. And the next thing you know, they focus on is if I could just get back to even, I'll get out. And it's really kind of a strange phenomenon. It's understandable, but a lot of people do get out as soon as they get to break even, only see the market continue to run not only higher than they ever thought it could, higher than they could have ever imagined. So it's just one more of those human conditions that as investors, we have to recognize real time that maybe we're succumbing to break-evenitis.
I think as an advisor, it's probably our job to try to head those things off in advance so that we don't allow our clients to get to that moment of surprise. And I think that's the goal. I think in the vast majority of our newsletters is really just to try to pre-warn folks, remind everybody of the flaws of behavioral finance and allowing yourself to go down these dark paths that don't lead to anything good. But that is our goal, is to try to hopefully head those things off in advance.
It's the same reason I do what I call lifeboat drills. Once or twice a year, I'll basically, anytime the market's doing real well, you clients will notice that I start kind of bad-mouthing the market in preparation for inevitable declines that come along the permanent uptrend. So just one more thing we get to watch out for.
And I think,
go ahead, David.
Yeah, I was going to say, I think sometimes people, they pick these arbitrary points. Maybe it is an old all-time high, and then they think it's meaningful, like it actually means something when the market hits that point, goes below it or goes above it. And at the end of the day, it's totally meaningless. So it was right before the market went into this most recent significant decline. We were talking to clients a lot more frequently about, investing at all-time market highs. And we were hearing at that time, oh, the market's too high, it's due for a pullback, and just those variations. And we actually recorded a video about investing at all-time highs. And one of the things we talked about was, look, if you look at when the market's at all-time highs versus not at all-time highs, and then you look forward 1 year, 3 years, 5 years, you look forward 1 year, it's positive like 70% of the time. Well, that's almost the exact same as if the market wasn't at all-time highs. And so people pick these arbitrary moments thinking that it tells you something about returns going forward. And if you look at the evidence, it really doesn't, kind of regardless of where you are.
Yeah, and I think the key is to really anchor to the plan. Don't anchor to a certain number. And that's just the bottom line of it is when people see these pullbacks or they do anchor to a certain number, they don't ask themselves afterwards if it goes below or above, well, how does that truly affect me? How does that actually affect my lifestyle? Because a lot of times these temporary pullbacks don't actually affect your lifestyle any. So it's kind of self-inflicted emotional turmoil, even though realistically your life is okay. But I get that it hurts to see declining balances, but I would just say always anchor to the plan. Don't anchor to a certain number.
That's a good point. Daniel finally made a good point on one of these. No, that's something I've never heard anybody say, and it's quite appropriate. Anchor to the plan. I mean, we should only always be relating through the plan.
Well, and I think we emphasize buy and hold investing so much. You know, people, they think, hey, I weathered the storm. I've done my part. You know, I can get out now. I haven't hurt myself. But what I think people fail to realize is they might be cutting off the second half of a rally. I think the numbers they gave in the article that you passed along were that, you know, the typical bear market doesn't start until another 44 months after a previous break-even point. So it's not like another one's always right around the corner. In fact, most of the time it's the opposite. You're cutting off really the second half of a bull market. And that kind of gets into our next concept or question that I want to talk about. You know, we're seeing a lot of people who see this market come back so quickly, and you hear a lot of people throwing around that it's just a bear market rally. You know, it's just the market recovering what it lost. It doesn't really mean anything. What's your guys' take on that? Do you think there is possibility for the market to keep going up, or do you think it is one of these bear market rallies? I know a lot of people are saying that the market's overvalued right now, and of course we hear that all the time. You know, what are your guys' thoughts?
Yeah. So I have a couple of thoughts. I still think we're in a secular long-term bull market. I don't think that's over. It began in 2013. They tend to run quite a while. That may or may not, you know, be true. So it doesn't matter how I feel, but that's where I think we are. And everybody's treating this as if it's the first bear market we've had in a long time. We essentially had one in 2018. We had one in 2016. We had one in 2011. Okay, technically they weren't bear markets, but tell that to when you look at all the broad asset classes through several of those bear markets that we weren't in a bear market. We were. So I don't see any reason. I don't think it's going to be easy. I think, but secular bull markets are much more powerful than people realize. We get 3 of them in our lifetime. Usually the first one, and when I talk about a secular bull market, I'm talking about a 15 plus or minus a few years type long-term trend. The last one, I would say, was 1982 through 2000. And the stock market went up about 13 or 14 fold. So they tend to last a long time, and they're very powerful. And they're cyclical bear markets, 20%, 30% declines within those secular bull markets. So, you know, and the other thing I'd like to add to that is there's no question in my mind, especially with when I looked at last week, that the Federal Reserve, there's an old Marty Zweig swing for anybody that used to watch Wall Street Week. He was a pretty frequent guest, and he always said, don't fight the Fed. And the Fed literally has put trillions of dollars into this economy. And now the minute the market went down about 10% last week in a couple of day period, the Fed stepped in and said, hey, we're going to start buying corporate bonds now. They've never done that before. I'm not sure it's even legal. There's other people that aren't quite sure it's legal. Regardless, they're doing it. That's the equivalent of saying we're also buying stocks. We're supporting the market. So it's clear to me that what we're seeing is a Fed-induced, I hate even saying that because I fought that after the 2008, 2009 Great Recession collapse. Everybody kept saying, oh, this is just a sugar high for the stock market. It's all Fed-induced. It was somewhat true, but not really. The earnings of corporate America just kept increasing year after year. We had good economic growth that produced pretty good earnings, and the stock market valuations followed that. I would say it's fair to say that Fed putting in $2 or $3 trillion of stimulus. We have personal savings that have risen savings rate that's risen from, maybe 7 or 8% to 30 or 35%. We've probably lost a couple of $1 trillion of demand that's probably just deferred demand. So I think it's perfectly, and we have essentially zero interest rates. So you're going to hear a lot of people say the market's overvalued here. I've been hearing that for almost 4 decades. I do believe, and this is something, Paul, you might want to, let's drop a die marker and we'll go back to it, is I do think when it comes to the broad U.S. stock market, it probably is, certainly was way overvalued before this decline. It's probably the more overvalued part. If I look around the globe, it's certainly the market that's probably has the highest valuation. In other words, it's expensive to buy it. It makes me wonder, and we'll go back to this, whether international and value and all these other things are going to start behaving a lot better. In fact, they have been in the last month or so. But you're going to hear people say the market's overvalued. There's going to be a million reasons that a lot of people will follow to miss this bull market and this continuation of a secular bull market. At least that's my thoughts. You guys can deal with it any way you want. What are your thoughts?
So I think my answer to, when people ask, is this, a bear market rally, or is there going to be a pullback or another shoe to drop, is maybe not. Like, at the end of the day, what you're asking is a market timing question, and we really don't know. There's obviously, no matter what's going on in the world, there's always a chance the market could decline from where we are currently. But there's also a chance that it could continue rallying, and you just have to go back to the past bear market or the Great Recession, 2008, 2009, and then the years since then, to see how poorly it can work out when you start thinking about, is the market overvalued? Should I take some chips off the table? How much you can cost yourself doing that, because there were a ton of people who got stuck on the sidelines. If the classic example, someone gets out at the bottom, then it shoots up like a rocket over the next 6 months or so from where it bottomed in March of 2009. That caught so many people by surprise. They missed out on huge returns. Well, then at that point, it's too late to get in now. The other shoe is going to drop, and then they get stuck on the sidelines longer, and it keeps going. And then even when you do have the little pullbacks, it's, oh, well, this is just the beginning. It's got further to pull back. So like you said, there's always an excuse that people use to keep their money on the sidelines, to not be invested. And you can just fall in this trap when you start trying to time the market or predict whether we're in a bear market rally or there's going to be another pullback. You just run the risk of getting stuck on the sidelines for a super long time and missing out on huge returns. And I know people who have done that, and I know a ton of people got caught in that trap, from March of 2009 to basically today.
I've seen people get caught in that trap since the Dow was, I remember when the Dow went, from 1966 to 1982, the Dow went from 1,000 to 1,000. By 1984, when I was in this business, the Dow was at 12 or 1,300, quickly went to 1,500. And all I heard from almost every investor was, I can't get in now, the market's too high. At 1,500, not 15,000, 1,500. So Dave, what you're really saying is maybe, but it's irrelevant.
What I'm really saying is we don't know. We could have a pullback. That's a distinct possibility, but we might not. So it's like, are we going to start making investment decisions based on my market forecasts, or are we going to just stick to the plan, like Daniel said?
Anchor to the plan, Dave.
Yeah. Thank you. I'm going to trademark that. I think it's, now I lost my train of thought.
That's okay, Dan.
You spent too much time in Alabama.
You were so
I spent two. Yeah. But, this is what I was going to say, is that I always look at that DFA study that says that if you miss 5 of the best days in the market, that you usually miss out on around 90% of the return. So I always think of myself like, man, am I that lucky to where I can make sure to jump in and out and still get those 5 days within a year? I would say no, for myself at least. And I feel like most people, that tends to be the case. So it's just you can't really afford to be out of the market at any time, because if you miss one of those 5 days, you're still going to really cut into your return for the year. And investors just can't really afford to do that.
One of the things that
oh, go ahead, Dad. Go ahead. Sorry, Ryan.
One of the things that I always think about is people think about getting out, and the thought is, well, you've stuck around long enough for the decline. You might as well hang around just a little bit longer to catch the rebound, because so many times we are just so anchored to staying safe and protecting what we have and not seeing it go any further below the potential low water mark that you're looking at that time. But you don't then think about, well, it's very possible, if not likely, that if I do get out, I don't catch the rebound like Dave was talking about earlier. So you might as well stick around for that rebound.
Yeah. Otherwise, you just end up in an emotional pressure cooker. So I've always thought that CNBC should run about every 90 seconds, like a Surgeon General warning below on that ticker tape that says anything that happens in the next 30 days cannot have any impact on the next 30 years of your life. So I think we've covered that pretty well.
Yeah, and actually we do not have any other questions. So I think we're very lucky. We have clients that are, very understanding of the way markets work and the way they are. Do you guys have anything else? I noticed 4 out of 5 of us went with the blue Ruedi Wealth shirt here. So Dave, you didn't get the memo on the uniform, I guess.
No, I broke the mold.
Well, again, we're living in interesting times. Investing is simple, but it's not easy. For all of our clients, we have a portion of their portfolio in the great companies of the world for a reason. And the reason is not predictability of returns. In fact, it's quite the opposite. We're in those asset classes because they provide the expected returns that we need for a client to basically get to heaven having done everything they wanted to do on earth. And unfortunately, the great prices of the great companies, I wouldn't say the values, but the prices of the great companies of America and the world fluctuate a lot, above and below a permanent uptrend. And as long as we can always step back, if we don't look at the market through a magnifying glass and we back up across the room and look at a long-term chart, it's the only hope we have to have that perspective, and we'll see that basically it's just a blurred uptrend line. We don't know the slope of that line, but the one thing's for sure, there's never really been any material return or an ability to really maintain or grow wealth in an all bond portfolio. So an all bond portfolio for 99% of the investors, that's just my guess number, but I think it's probably right, it's a non-starter. It's never going to work. So for most people, they don't have any choice but to permanently have a pretty good part of their portfolio with partial ownership of the great companies of America and the world. And we just have to put up with some of the shenanigans it does along its drive along the permanent uptrend. And if we can do that, everybody's going to have a delightful life and do pretty much everything they hope to do throughout retirement. We'll make adjustments where we need to. The guys and I, we follow a very strict set of rules on when and where to make adjustments in a plan. We find that those adjustments, even when they call for modest spending decreases, are welcomed by clients, and they should be. It just means that we're doing what we said we would do. We're going to try to protect their standard of living for the most years that they can, so that they can have the best life they can with the money and the income streams they have. And I think the guys have done a good job of continuing my message. I'm not going anywhere, but they've done a really good job of basically parroting, maybe even a more strict sense, David, than I do. I'm a little freer with my rules, but we do follow rules, and that's the key. So we have a plan, and we follow the rules to make the adjustments. Clients continue to tell us they really don't worry too much about their retirements. Anybody else have anything?
We can leave it at that.
That mean I get to go fishing with my grandkids?
There's a lucky one. Maybe I'll do some fishing today. I am in Alabama after all. I think that's all they do here.
That's all they do in Alabama is hunt and fish.
But yeah, I would just say, life is full of potholes, and you're going to drive along and you're going to get some bumps, but you're going to get there eventually. And our goal is just to avoid the sinkholes, and we'll reroute you if necessary onto a different road.
Oh,
I feel like
a lot of them today.
I feel like that's necessary to say. You know, Illinois, kind of bumpy roads. Let's say we're going down Windsor. You're still going to get there.
Oh no, Daniel. See,
Hey.
Daniel hasn't been in town for a while. They've resurfaced all of them.
Resurface it. Well, there we go. That's nice.
Well, guys,
Now,
we'll go.
Daniel, are you going to
What's another
say?
bad road?
So my neighbor Daniel's going to say we're essentially resurfacers, right?
Yeah, we're
We fix the
resurfacing.
potholes. All right, Daniel, go anchor to fishing or something, will you?
Oh, I will.
Yeah, I think we'll leave you with that. Anchor with the plan, not your investment returns. We'll go ahead and see you in a couple weeks. Take it
All
easy,
right.
guys.
Thanks.